All right, thanks Kyle earlier for scaring everyone with your bond charts there. We'll try to spice it up here. So everybody wants to know what's going on with the housing market here. Obviously, we had a huge run up during the pandemic, during the COVID times. Home prices ultimately peaked in March. Interest rates went up 400 plus basis points, and then they seemingly bottomed in December. So highly levered economy, highly levered household sector went through a 9-month correction, and it seems like we're off to the races again. So everybody's wondering just what the hell is going on. Was that truly the bottom, or is there more pain to come? Obviously, we've got Kyle's scary bond charts telling us the recession is imminent, and so how is that all going to play out? So I'm going to kind of give you guys a feet on the ground perspective, looking at some of the stats as well I'm looking at on the housing market here in Vancouver. So it is important to contextualize that, we just had the Bank of Canada come out raising rates, and they said, and one thing they mentioned is they talk about the housing market showing more resiliency than they were expecting. And so one thing that I would sort of make note of is that this is not a demand boom, but this is actually a listing issue. And so, remember during the pandemic, it was everybody wanted more space, everybody wanted to upsize, everybody was relocating, you no longer had to go to the office, everybody was seemingly adding to their investment portfolio, pre-sale condo, et cetera, et cetera, et cetera. What we're seeing now is that sales are actually still relatively quite weak, but you have very few listings. And so in 4 of the past 6 months, in the greater Vancouver region, you've had 20-year lows in new listings. So people just aren't listing their homes for sale. And I think there's multiple reasons for that. I mean, a lot of the conversations I have has been so much volatility, so much uncertainty over the past 12 months that people aren't sure if they should move, should they be hunkering down. Obviously, when you go to sell your place, you need to go and buy something. If there's nothing on the market to buy, you're trying to upsize, well, you got to qualify at a 7% stress test. And so basically people have just been sort of sitting there and like almost in shock and not really sure what to do. So there hasn't been any inventory coming to market. If you look at standing inventory, which is show me how many number of homes are currently listed on the market for sale today, and you have essentially a 20-year low, just under, our data goes back to 2005. So this is for April. I can tell you the May data came out is exactly the same. So if you're a buyer out there that's actively looking for housing, you have very little selection. And the reality is that there's always people in any market that need to move. People relocate for jobs, there's divorces, you've got a young family, you're not going to delay your move when you want your kids to go to a certain school catchment and what have you. So people that are actually out there trying to make real estate purchases today, they're making them in an environment where there's no selection. And because of that, they're having to compete. So we've got bidding wars have returned. So this line here, you can kind of see every time you sort of have these peaks, they typically tend to coincide with these bull markets. So you can see 2015-16, we had a little bit the rebound back into 2017 as that mortgage stress test was coming out. You had all these people sort of pushing purchases in advance of that stress test coming in. And then again, of course, you can see the pandemic bull market there, where we had at one point 60% of the listings that were on the market sold above the asking price. So this is the percentage of listings that were sold above the asking price by month. And so right now we're up around close to 35%. So again, people are out there, the ones that are having to buy are having to compete, and thus anytime you tend to compete, you tend to push the prices up. And so I think it's important to contextualize that you can't paint necessarily the market with a broad stroke, but basically the segments that we're seeing that are so in demand right now is really, I think the number one driver is really, it's all about affordability. And so what we're seeing is this millennial generation that's coming up. They tend to want the 3-bedroom homes, so 3-bedroom townhouses, 3-bedroom single-family houses. And of course, if you're from Vancouver, we don't build new single-family houses. The net supply is contracting every single year. And so that's where you're seeing most of the demand. So if you look at it right now, you've got just over 2 months of supply for detached houses under 2.5 million. Now, and again, for most people, they tend, I'm not going to show you a chart of $4 million houses. It's not a product that most of these families are looking at. So most people, when they say, how's the market doing? They're really asking, how's the market that I'm looking at? How is it doing? And so detached houses right now, if you're looking under that $2.5 million bracket, you've got just over 2 months of supply. And so it's really hard, even with interest rates, mortgage rates at 5%, it's pretty hard to have a price correction or a substantial price correction when you got inventory at 2 months of supply. It's just not enough. So the reality is right now, sellers have the upper hand despite mortgage rates being egregiously high, or obviously on a relative basis over the past 18 months having exploded higher. So that's kind of what's driving things, and you can apply this for, we've got a lot of first-time home buyers entering the market. So if you look at one-bedroom condos, there's less than 2 months of supply, and so that's why we're seeing those prices start to accelerate higher once again. And so it's interesting because I think there was certainly a narrative coming into the calendar 2023 year, which was, okay, the market peaked last year. There was this crazy run up in COVID. Everyone's been talking about this housing bubble. All of a sudden, mortgage rates go up by 300 basis points. Bank of Canada raises rates. Everybody just naturally assumes the market's going to get flooded with inventory. You're going to have a wave of foreclosures, people that can't afford their homes, listing them for sale. And so we actually end up getting the opposite. So I think it kind of goes to show it is difficult to obviously predict markets. But one thing that I always tell our clients is, the one thing that I can tell you is I can give you a pretty good clarity on what the next 2 to 3 to maybe 4 months look like. And that's simply by looking at months of inventory for sale. If you've got less than 2 months of inventory, prices are probably going higher. If you've got north of 4, prices are probably going lower. So I can give you a pretty good range over the next 2 to 3 to 4 months. And then after that, of course, that's where your macro starts to factor in. Where interest rate's going to be 6 months from now, that's going to play a part. But certainly, this is where we're at today. Again, it's not a demand-driven story. We have a supply issue right now. I don't think a 20-year low in listings is sustainable. At some point, people will come back to the market. I don't know necessarily when. I think we're starting to see some moderation in listings, hopefully a return to normal. But that's sort of what's driving the housing market right now. And so, another part of this, when we talk about the one-bedroom condo market, you can see there's less than 2 months of supply. Well, the rental market's in shambles. We had, record permanent resident growth in the Q1 of this year. You had record non-permanent resident growth as well in the month of April. And so you're importing all these people into this country. And of course, we already know there's a supply issue. So here you can see in Vancouver, rents are up 15% on a year-over-year basis for a one-bedroom unit. So what you see is a lot of first-time home buyers. You go, okay, well, I was renting a one-bedroom place. I was paying, $1,800 a month. My landlord just sold. I now got to move out. The new rents today are $2,500 a month. I don't want to go through the same process where I'm in this place and every 2.5 years I'm getting sort of evicted because my guy's going to sell, and I'm subject to these new market rents, which seemingly just keep pushing higher. And so this is why you're seeing obviously a lot of first-time home buyers trying to get into that one-bedroom market. And the reality is it's a competitive market. The floor for a one-bedroom condo pretty much anywhere in Greater Vancouver is essentially anything under $600,000. So when you're left with very few options, which is the really tight rental market, you tend to see people obviously pushing into the resale market. So can this be sustained? Not if this guy has his way. Of course, Tiff Macklem coming out, surprising everyone with another rate hike here. It was interesting because there was a prominent real estate group here in Vancouver, not going to name names, but one of their forecasts to kind of start the year, which always goes to show you forecasts are difficult. But they say, the housing market's going to recover this year, prices are going to go up, and we've got the Bank of Canada is going to start cutting rates in July of this year. Well, of course, that hasn't happened. And one of the arguments I made at the time was, okay, that feels good. Prices are going to start going back up, rates are going to get cut, we're going to get back to normal. But if you're the Bank of Canada and you're going, gosh, I just raised rates, 425 basis points, and people are still bidding up housing, why would you cut rates? And so I think it's just giving an excuse for the Bank of Canada not only to start hiking rates again, but I think we're going to be potentially in a scenario where it is going to be higher for longer, because so long as the housing market remains resilient, which is a large component of our economy, I think it gives them every excuse to keep rates, again, higher for longer. So Tiff Macklem clearly says, listen, we need to slow the economy, and housing being one of them, is so long as housing prices are still accelerating to the upside. I think that's certainly giving them concern, and they talked about it in their most recent speech. So that's why they've delivered here another 25 basis points. If you listen to the interview from the deputy governor, a guy named Paul Beaudry. The following day afterwards, he gave about an hour-long speech. It was very hawkish, meaning they basically came out and said, listen, the data has surprised us and we are concerned. And so based on a lot of that, I think you can make a pretty strong argument that you might get another rate hike in July based off that speech. Again, are these guys leading economic indicators? Probably not. But like I said, when you talk about housing, they're talking about the resiliency in housing, and I think it's more of a supply issue where people just 20-year lows in listings isn't really a demand boom. And so, as of right now, you've got the largest cumulative rate hiking cycle since the 1980s. And again, I think it's pretty interesting when you actually start to adjust for, remember the 1980s, obviously house prices were much lower, household debt levels were obviously lower on a percentage to GDP basis. So I think there's going to be a lot of people feeling this. Now, one thing that the Bank of Canada has noted, and we talk about the resiliency in housing, is only 1/3 of Canadians, 1/3 of people that have a mortgage have actually seen a payment increase. So realistically, these rate hikes haven't actually filtered through. So again, in my opinion, I still think that there's a lot of headwinds coming for these households. We have these conversations, a lot of them, some with clients, some with investors, some just random people will call me up on the phone and say, hey, here's my situation. I've got 3 rental properties, all on variable rate mortgages. I was cash flow positive $300 a month. Now I'm losing $400 a month, times that by 3 properties, and the BC government only allows me to increase the rents by 2%. What do I do? And so that's a pretty tough predicament. We are seeing obviously some of them saying, okay, well, I've got 3, let's offload 1 and start from there, clean up the balance sheet a little bit, get some breathing room. So I still think there's a lot of risk there, as there should be when you raise rates at the fastest pace that we've seen going back to the 80s. Long story short, I think I've got higher for longer. I do think there is some pain coming. When the rate hiking cycle began, the price of a ticket. Well, give you an example here. In March of 2020, the Bank of Canada officially raised rates 1 month after the housing market peaked. So again, these guys aren't necessarily, I would say, ahead of the curve. I think that they're kind of looking in the rearview mirror. They should have probably begun raising rates in 2021. But again, they raised rates officially after the national housing market peaked in 2022. And so at that time in Greater Vancouver, the price of a typical home, which is all property types, I'm not talking about detached, I'm saying if you take condos, townhouses, and detached, and you look at the home price index created by the Real Estate Board of Greater Vancouver, the price of a typical home was $1.26 million. So if you assume that you took out an 80% loan-to-value mortgage at about 2.2% at the time, your monthly payment would have been about $38.25. Today, the mortgage rate's about 5.2%, give or take. So your payment today would be about $55.05 on the same price. And so that's a monthly increase of $16.80 per month. Now again, as I said, only about 1/3 of people have actually seen a payment increase. So some people have these fixed rate mortgages, which are going to come up for expiry in the next couple of years. You've got some people that are on these variable rate products, but only of the big 5 Canadian banks, only one of them, which is Scotiabank, has a floating rate. Most of them have these static payment variables, which is not allowing, they're basically deferring the interest, and a lot of the times they're tacking it onto the balance and extending the amortization. So you're kind of like, essentially you're just kicking the can down the road and saying, we'll figure it out later. Hopefully rates go down in 3 or 4 years. And so that's why, I'll give you an example. I had one guy call me up and he says, I bought a house for $1.8 million in New Westminster, and it's rented out right now, and I'm thinking I want to sell it. What do you think? I said, well, I can sell it for you. You're probably going to lose about $200,000 after your real estate fees and everything. So he goes, no, don't worry about it. I'll just kind of hang on to it. I said, oh, that's good. You've probably, obviously you've locked in your mortgage, because otherwise. He goes, no, I've got a mortgage with TD Bank. It's on variable. They haven't raised my payment. I said, what do you mean they haven't raised your payment? It's 400 basis points later. And he goes, no, what they're doing is they're just adding the interest. So they're $800 per month was just kept adding to his balance. So his payment basically became not only interest only, but it was not even covering all of the interest. So $800 per month was actually being added on to the balance of the mortgage. And so long, they would allow him to continue doing that until he hit 80% loan to value. Because he originated the loan at a 70% LTV, so he could keep doing it until he got to an 80% loan to value. So if you actually look at it, he actually had a long runway to keep doing that. But it's not a great investment strategy. But nonetheless, this is why I think you're not seeing the wave of supply coming to market, is banks are ultimately trying to sort of manage this. And as we talked about 20-year lows and new listings, well, that should be a new listing coming to market. But again, I think the banks are ultimately kicking the can down the road. So so supply is keeping prices in check, but the risks are elevated. Like I said, as of right now, the next 2, 3, 4 months of inventory remains incredibly low. That's not a market where you're going to see prices decline. It's simply not. Now, if listings start to pick up, demand starts to slow down because we've got another rate hike, et cetera, then I think you can start to see the inventory start to get back to more balanced levels, and then maybe you get some downwards pressure on prices. So the biggest risks are investors hitting the sell button, which is what I said earlier. We do tend to get a lot of investors that want the liquidity preferences, so they will go variable rate mortgages, right? So that's a risk that still hasn't really surfaced, in my opinion, into the market. And then you've got pre-sale condo buyers. Again, if you bought a pre-sale 2 years ago, you most of the time you're not getting a pre-qualification, and when you bought, the rates would have been about 2.5%, 3%, and today obviously you're looking at 5 to 5.5%. So that's a real risk, and the question is, are you going to be able to qualify to close on that product? I've included a chart here which shows the inventory of assignments for sale. So this is the number of pre-sale condos that are listed for sale on the MLS as an assignment, saying, "Hey, I don't really want to close on this. Can you please purchase my piece of paper and take over the obligations of this condo?" So it's elevated. I mean, granted, it's been elevated for several years, and it so far hasn't been an issue. But I think if interest rates remain higher for longer, it could potentially become an issue. The spring market, ultimately, in my view, it might have been a sugar high. Prices have jumped quite a bit. It's actually it's hard to believe. Again, we went through this 9-month correction, and all of a sudden, the price of a typical detached home in Greater Vancouver is up about $150,000 in 2023. So it's a big jump. And is that sustainable with mortgage rates at 5%? I suppose it is, so long as listings remain low. I'm just not necessarily convinced that listings can remain at 20-year lows. And so I would just say proceed with caution. As we've talked about, there is this potential of this looming recession. So I still think it's a time, again, to proceed with caution. So that's it.